So from this chapter on, we're opening up the economy. Opening up the economy, what we mean by that is going from a closed economy to an open economy, is we're going to a situation where we now allow trading to occur with other countries. So a lot of the concepts we're going to learn in this chapter here are concepts that we've already seen, and a lot of concepts that we'll see in the next few chapters deal with stuff that we've seen, but we're adding that extra layer of having an open economy. So if you see stuff here that you're like, well, I don't really quite get this, well, make sure you go back to those chapters and understand it well. Like the second section on saving versus investment, make sure you understand it well in the closed economy, and then you could add up that extra layer of open economy. So in this whole situation here, we take for granted, as in microeconomics, that there is gains from trade, and pretty much always is. Some people could have more bargaining power than others, but typically there is gains from trade, and we promote trade here. So let's just see how things work when we have trade. So when we have an open economy, we trade goods and services, but we also trade capital assets such as stocks and bonds. So there's that bilateral flow of goods and services or assets, and we'll kind of distinguish the two. So when we're talking about exports, imports, and trade balance or net exports, here we're really just looking at all of this from the goods and services approach. In a second, we're going to talk about net capital outflow, and that's going to be looking at the actual capital flow, the assets, the financial assets. But for now, we're looking at the goods and services. So exports, goods and services produced and exported. So wood, our raw materials, wheat, pork, maple syrup. Imports is anything that we're importing, goods and services. So we could import bananas, we could import coffee, other things like that. And then exports is that value of nation's export minus the value of its imports. So if we have a trade surplus, it's when we have more exports than imports. A trade deficit is when we have more imports than exports. And balanced trade is a situation in which exports equal as imports. I'll repeat this a few times, but a balanced trade does not mean that you're not exporting or you're not importing. It's just it has the same value. If we look at these tables here, at this table here, these two bottom ones is with the United States, and then it's our total exports and imports. If we look at with the United States, the last few years, we've pretty much had balanced trade. We've had years before that we were exporting more than we were importing from them. So we had a trade surplus here, and over here we had a trade deficit. And if we look with the world overall, we're importing a little bit more than we're exporting. And that fits well with what we've seen in Chapter 5 towards the end when we were talking about what's GDP constructed of in Canada. Well, we had that net exports area, and it was a slight negative. It wasn't that big, the negative, but it was a slight negative. And the reason for that slight negative is this area here that we're exporting just a little bit less than we're importing. Well, we could see that our trade is a big percentage of our GDP. So far we've seen the concepts of exports and imports. So what happens when a country exports more than it imports? So we need to understand the concept of net capital outflow to understand this, and we'll go through an example. This concept of net capital outflow, if you look at other textbooks, they might talk about capital account. But for this one, just think about net capital outflow. It's really the purchase of assets by domestic residents minus the purchase of domestic assets by foreigners. So when there's a net capital outflow, we're getting more assets from foreigners than they're getting from us. We'll see how that works in a sec. Here's an example. Canada purchased $100 billion worth of goods and services from the rest of the world, and during the same year, the rest of the world purchased $150 billion of goods and services from Canada. Canada has a trade surplus of $50 billion. If you think about it, you could also think about it with a friend. If you're trading goods, he's bringing goods that he has for sale. You have goods for sale, and his stack of goods that he's buying from you is $150, and you're buying $100 worth of goods from him. In that situation, there's two different things that could occur. Either you decide to get more of his goods. You're like, well, I'm giving you more value than you're giving me, so I'm going to get an extra $50 from you. That's one thing in terms of like an extra $50 worth of goods. Or you could simply say, I don't want any more of your goods. Give me an extra $50 in currency and treasury bills and bonds and stocks, any form of financial asset, or give me like part of your land or something else. So all of those different things that you could be compensated for if they're not goods and services is that second class, and that's the net capital outflow. So in this case here, we'd have net exports of 50 and we'd have net capital outflow of 50. If ever we decided to go this route here and get more of his goods, well, net exports would be equal to 0 and net capital outflow would be equal to 0. So an example such as the one explained makes you think of which situation in the world markets. Well, think about it as any country that tends to export more to the other than the other one, and a flow of money. So an example that we've heard a lot in the past, if you follow the news, is USA and China. Well, for many years, USA has been importing more from China than it has been exporting to China. Therefore, it owes China stuff. And what China's been getting in exchange is a lot of the American debt, a lot of treasury bills. And that's why we say that the Chinese own a lot of the American debt. It's due to that massive trade imbalance for so many years. So what are the variables that influence net capital outflow? We talked about variables that influence net exports, just desire for those goods. But there's also the things that influence net capital outflow, which we'll see as the real interest rates being paid on foreign assets versus domestic assets, and perceived economic and political risk of holding assets abroad. We'll talk more about that later as well. So we've understood the kind of net exports to net capital outflow. We'll see that they're linked. We kind of already seen that they're equal to one another. And we'll see more of that in the next few segments.